So welcome to the Beats Roundtable. I'm Nadine Terman, and it's Thursday, April 11th. We'll be walking through top investment ideas with Catherine Spurlock. She's going to tell us, could something become a diamond in the rough? David Maris, who's going to be walking us through a pharma name that everybody knows. Bob Morris, energized with one of the name that I actually hold. And Paul Meeks, with a name that everybody on this planet hears about every single day. But the question is it time to enter the room if you missed the party? So I'm giving you some spoilers there, but let's head it over to Catherine. Catherine, what is going on with diamonds in this world?
Well, I want to talk about Signet. I think the street underestimates the negative impact lower asking prices might have on the company's financials and cash flows. By way of background, for those of you that don't know Signet, it has Jared, Zales, uh, 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 and 2,700 stores around the United States and the UK. I'm sure you've heard the jingle, every kiss belongs with, or every kiss starts with K. This is a company I have followed for many years, and I believe that the Street doesn't understand that a majority of their revenue and profits come from what's called an extended service plan or warranty on your diamond ring or jewelry. And as asking prices continue to see pressure because of the growth of lab grown diamonds and increased competition from companies like Walmart or JC Penney's and so forth and so on, the profits the company generates compress accordingly. Importantly, the company has guided to an acceleration, or a resurgence in engagement sales or bridal over the next couple of years, which I think is it seems aggressive, given the long-term trend in lower marriage rates. This is important because 50% of their sales are to bridal. And within that, 80% of those bridal customers purchase these high margin extended service plans. And so as the asking price goes down, the profits for which that are generated from these high margin plans compress as well. In addition,
But we know that these lab-grown diamonds and other jewels have really come down, like put pressure on prices for actual diamonds. Are you saying that the prices are going even lower from here, or that no, that they actually haven't been hurt by that trend yet, and they're going to be hurt by that trend? So what's going to keep pressuring the prices here, and in addition from that, the follow-on revenues from the service plans?
The extended service plan, the diamond pricing have fallen. The lab grown diamonds have the lab grown diamond prices have fallen 86% since 2018, and they continue to fall. And that pressure impacts all jewelry sales, all gem sales, because it puts downward pressure on natural and lab grown. So that is continuing. In addition to that, the company modified the way in which it recognizes deferred revenues over the past 2 years, which also creates a negative compare or a difficult compare. So it looks like it trades cheap, but the company will see pressure, I believe, over the next year.
And so would you short it from here? Is that the call, or just don't go in it? What's the call on Signet?
Well, as a reformed short seller, everybody can make their decision accordingly. The stock missed earnings and guided down when they reported Q4, but subsequent to the quarter end, they repurchased their convertible debt and reduced the share count. The stock has thus rebounded. So everybody take a look.
I got a new level to go from. Well, thank you, Catherine. Let's pull it over to David. David, what have you got for us here? We know there's a name with a catalyst-heavy year coming up. What do we do?
Yeah, so this is TEVA, TEVA, generics powerhouse, one of the biggest generics companies around. I've been long it for on and off for the last couple of years as it's been doing a turnaround. And at the start of the year, I bought it, thinking that, well, what's the most hated sector in all of healthcare? And it's probably generics for good reason. They've all of them have over levered themselves. They've been missing earnings, intense price competition. Um, in fact, even Novartis spun out their generics division because they didn't want that albatross around their neck. So why Teva, one of the ones with the most amount of debt? Well, they're slowly paying down this debt, and they have a couple catalysts this year on two products in their pipeline. They both look pretty good. They look like very low risk products on the branded side. And they have a new CEO who's about a year into it. They just put up good numbers on their fourth quarter. And that's kind of what got me involved because I was looking to the fourth quarter and thought it was going to be good. It turned out to be good. And this is a simple 5 times earnings stock that went to 6 times earnings. All I'm hoping for is 7 or 8 times earnings. And I think that the numbers for this year are pretty good. Next year gets a little dicey because they have some debt to restructure, but I think they're going to be able to do that.
Okay. And how much, when people are in this name, obviously, people are talking about the catalyst this year and the debt story, but if inflation stays high and rates stay high, are you concerned with this name, or is it really more, can the CEO restructure what it has? It's really not about rates, it's about restructuring. Like what's going to enable them to thread the needle next year on that debt?
I'm glad you said thread the needle because that's exactly what this is. And that's why I say it's a small position for me. And I have a tight stop because I'm a little worried about this. Because on the debt side, they're going to be able to pay out they have about $1.5 billion, almost $2 billion due this year. They're going to pay that out of existing cash and cash flow. Next year, they have to refinance about $3.5 billion. The current rate is at 3%. They say they're thinking about 7 for the new debt. Well, they also have a couple of these products that they should get approval on this year or data on this year. And if so, things are going to look a lot better. So I think that they're also spinning out one of their businesses. It's an ingredients business. It's the largest in the world for drug ingredients. And if they can get a couple $1 billion for that, I think that's going to go a long way to the $3.5 billion that they have to refinance. So I think actually they're going to spin that out, pay down the debt. They'll have maybe $1.5 billion to refinance, and it might be at double the rate, but it's not going to be a negative headwind.
Right. That's great. That's helpful to know because, one thing as we all go into names, like, okay, well, people will always look ahead, but it looks like they have not just catalysts for multiple expansion, but catalysts to be able to pay that debt down, or at least to be able to create the storyline of what they're going to do with it, which then probably opens up that multiple expansion as well, right? Because people can get more comfortable.
It is an interest rate sensitive name in a weird way because of all their debt. So that's why I'm so careful about it. It is literally threading the needle.
Got it. Thank you, David. Next, Bob. Bob, we own this name. What are you doing with CNQ? It's for personal reasons, not just to share with the world.
Yeah, this has been
they've had a great ramp. So.
Yeah, this has been a great stock. As you know, I own it. It's my largest position among energy stocks. We spoke about this right after the reported earnings, and then I said I might be being a little bit too cute and not just buying it, but maybe writing $65 puts. Well, since they reported earnings and raised the dividend on February 29th, the stock's up 25%. It's at an all-time high. And since earnings, that 25% increases versus a 14% increase in the XLE. And the XLE is up, 15%, which is outperforming the overall market. So this stock has strongly outperformed both the energy sector and the broader market since they reported first quarter earnings. At the same time, what's helped it along here is oil prices are up about 10%. And, the dividend yield on CNQ right now is about 3.8% on yesterday's close, which is a great dividend yield. As you know, I've talked about the dividend, in my opinion, being very safe. They've raised this dividend every year. Even when oil prices were below $20 a barrel, they raised the dividend. But with WTI spot oil prices over $86 a barrel and Brent just over $90 a barrel, the oil price is incorporating some heightened geopolitical risk premium, in my opinion. And I think that's not likely to dissipate anytime soon, just given the circumstances with Israel and Iran and the whole situation in the Middle East. At the same
I think we might have lost Bob on this one, but I think you meant to say, like, at the same time, you got to be careful, right? Geopolitical risk, any kind of solution, you got some trouble. But yeah, I think we've got you back now, Bob.
I see myself, but I can't hear me.
Can't hear you, though. But
am I here?
I guess, like, moving on, you know, I've been happy they've been returning free cash flow to shareholders, bringing net debt down. So, you know, from what I know, what Bob was saying is that he's saying here's probably not the time to be going in the name after the big ramp up. You can just get on Bloomberg, check out CNQ, or I guess Yahoo Finance for those who don't have Bloomberg. But it's been a mega ramp after that earnings. So I guess the question is, do you buy puts? Do you protect this name? Do you trim it? And I think the answer is you probably need to protect this name. So finally, let's go on to Paul. Paul is in his car. He's headed somewhere good. But take us out here with the name that I'm sure everyone and their brother, sister, mother, cousin want to know. What do you do with NVIDIA?
Everybody's probably saying, oh, boring. But I will tell you that I've been active in the name on the buy side. You know, the stock is back up the last two sessions a little bit, but not a lot. But earlier this week, you know, the stock had troughed after a 10% correction. And I don't know if we're through the trough. We'll see. But the trigger here has been some purported, and I say purported in quotes, product announcements from alike of some of these customers that are going to be desperate to vertically integrate to lower their costs in AI chips. Intel had an announcement. Meta had an announcement. Alphabet had an announcement essentially in conjunction with ARM.
Right.
And what I would tell you is I believe that in AI, the large language model building continues far longer than people expect. And that business will continue to be dominated by NVIDIA, essentially all the share. And in the next step of AI, inference, they will lose some share, but their current estimates for strong growth will continue just because that'll still be a growth ramp for them. When I take a look at the competitors, you know, Intel has long been the manufacturing company that couldn't shoot straight. I'll believe it when I see it, even though the company's now better run under CEO Pat Gelsinger. You know, the other day they announced their breakout results for their outsourcing business. I know it's not directly related, but that outsourcing business doesn't look like it's going to be profitable until 2030. And so things are not as smooth as you think they are. So I'll believe the AI threat from Intel's chips when I see it. I just don't trust, and I think there's too much in this announcement that's hype. Meta, I think Meta, the way they're going to end up in this space is, yes, they will work to design their own chips, but they are going to cooperate with NVIDIA just as much. So it's kind of a co-option relationship between those two, which I don't think really threatens the NVIDIA franchise. And then with Alphabet, you know, Alphabet is great at a lot of stuff, digital advertising, but not necessarily a player in the manufacture of hardware or semiconductors.
Right.
And even with the assistance of ARM, I also think that AI chip threat is overemphasized there. In the meantime, it did cause a considerable correction, 10%. For NVIDIA. What I did specifically on the trade is in the last couple of days, I added to my position, which was already large, with an 850 buy limit. And at that time, it looked like the stock was going to go lower. And I decided I was going to buy some more at a successful test of the 50-day moving average at $8.13 a share. Now, the stock has moved away from that. But on any whiff of more of these competitive announcements for these companies that try to become vertically integrated, the stock will go down for sure. And I think we're going to have many chances to buy more NVIDIA on a dip, and that's specifically my strategy.
That sounds good, Paul. Basically, get in when you get the opportunity, and there's these headlines, as we saw with Apple trying to do a car. I mean, Just because you're successful in one area doesn't mean you're going to translate that, especially into an area here where such a competition for talent, such a competition for capital, so across the board. So what you're
Yeah.
saying is buy on the headline here. So that's it for today, April 11th. We've had Catherine with Signet, David with TEVA, Bob with CNQ, and now Paul with NVIDIA saying, hold on to that and keep adding. So don't get worried by the headlines. Just keep your eye on the prize, the intermediate term, and be a long-term holder. Thank you very much, and we'll see you back tomorrow.